I look at what happened over Monday into Tuesday, Wednesday, Thursday. It is fairly evident that people want to buy these stocks on discount. Is it still a good idea?
Yes, I think it's still a good idea. I mean, you did see a 10% correction in small cap stocks. You did see, I think, a 10% correction in financials, some of these areas that had been doing really quite well. I think there's still the sentiment out there that you can buy this dip. And, I think what's really happening this week is it's being supported by earnings. And earnings have been coming in quite well, especially in the value space, but also in the growth space. And I think that's kind of bolstered markets. And it's really amazing how short-lived these sell-offs have been. Choppy markets, but, investors keep coming right back in.
Sean, over the last 12 months, the two biggest dips that we saw were pretty much at this same time last year going into the fall. It was roughly 9 to 10% that we saw twice happen. Since then, we've seen like maybe 5, 6, half dozen around there, 4% type pullbacks. Is this pretty much the regime now? Is the macroeconomic backdrop, is the earnings story good enough to just say, hey, stocks go on discount, they only go to 4 to 5%?
Well, I think what we're seeing with some of these short pullbacks here is really related to what's happening to the Treasury yield. Financials trade really much in line with what's happening with the yield curve. That's one of the reasons they've pulled back. I think the same thing for the energy space. I know there's things going on with OPEC, but it also trades with yields. So lower yields has really kind of caused some consternation, but it looks like maybe they're bottoming out here. Or at least getting closer to it. So I think that is seeing some renewed interest in maybe some of those spaces. But, growth is doing quite well as well. Investors are kind of flocking back to some of those familiar names just in case the Delta variant does end up becoming a significant issue in the next few months or heading into this fall. So I think it's going to be choppy for a while here as we kind of try and figure out what the new backdrop is. And there has been some signs of slowing growth, right? Atlanta Fed GDP has come down from over 10% to around 7.5% in just a very short period of time, about 3 weeks. And Chinese growth or economic activity slowed as well. So there's a lot to digest here.
So it sounds like you are in that camp, as pretty much everybody is these days, that the Delta variant is one of the largest variables out there. If that's the case, and if the slowdown story is one that you have to kind of hedge against, what exactly then do you do? What is the strategy, so to speak, for how you position for that? And then what exactly do you look for to put on your shopping list if things do pull back, hypothetically, another 4 to 5% again, if not more?
Sure. I think what we've done and what our CIO has recommended is that you could potentially have about 10% of your portfolios in a medium risk portfolio in what we would call dividend growers. And these are, dividend aristocrats. Companies that have shown really strong earnings growth, stable earnings growth, positive dividend growth over the last 25 years. Those are companies that tend to do well, kind of through the choppy times as well. You catch most of the gains on the upside, but you limit some of the losses. So we're looking at dividend growers in particular, not just in the U.S., but overseas as well. You think of the UK, for example, it has a dividend yield on the FTSE 100 about 4.2%. So that's sort of how we're hedging our bets related to Delta variant.
Shepard Smith here. Thanks for watching CNBC on YouTube.